Welcome to another very special episode of Honest Money. We're talking tax today, and this is definitely a critical topic, but it's one of my areas of weakness. So whenever I have a gap in life, I always make sure I bring in a guru to help me and then help you guys who are listening to the show, so that we all make the best decisions we can. So I'm thrilled that we have a repeat guest, André Bothma, who runs a business called the Tax Maverick. André, thanks so much for joining us.
Thank you so much for having me, Warren, and the rest of the team at Honest Money.
So André, we've got two questions from listeners. So I thought we should kick off with those, and then we'll then address some of the other issues around tax, and also just to talk a little bit about the Tax Maverick, because I think it's a classic name and it's an important thing in people's lives. So we're just going to play the question, and then we'll kick off with the what we both think about this.
Sounds good.
So tax-free savings accounts and annual limits and lifetime limits. It's something that does catch a lot of people out, because they think it's 36,000 Rand for the lifetime or 500,000 Rand every year. And so just check me if I'm wrong, but my logic is we are allowed to put in 36,000 Rand a year, and we can do that however we want. In other words, we can do it as a debit order, we can do it as a lump sum, we can do it in batches, but we're not allowed to do more than 36,000 Rand in any 1 year. And then we can do that every year until we've contributed a maximum of 500,000 Rand.
Yeah, that's correct. So you can do it staggered. You can do, I know some people, they prepare to actually make the lump sum as soon as March hits, and you sometimes see those tweets actually coming up. And then you've got the lifetime limit of 500,000, and just with basic math, it takes about 16 years of 3,600 or 36,000 Rand to get it up to 500,000. So I'm actually hoping that they either up the lifetime limit or the annual limit, so that you can reach the lifetime limit quicker. But yeah, that's just an opinion. I think
they've done that once, if I remember. They
increased the monthly that you can put in.
Okay.
I think it was 2,500 Rand when they started.
So now our listener wants to know, how does SARS know when you're going over the limits? Is there some kind of a reporting mechanism? How does it work?
Yeah, so SARS have very good third-party reporting technology, and so any of the financial institutions, like they share your IT3B data, which is like your investment income data, they share the same tax-free savings account data with SARS. So what happens is when you actually when you request your tax return, it also pulls through your tax-free savings account information. And so it is easy to see, or at least on SARS side, for them to see whether you've exceeded the monthly or the annual limit. But also there is the standard check at the financial services firms where you can't, where they actually try to stop you or prevent you from contributing more. So I think that will only come in if you contribute to two places, but then you over contribute. So, but SARS does know due to third party.
And I think the critical thing here from an investor point of view is just know that everything that you over contribute to your tax-free savings, SARS can penalize you 40% of that over contribution. So it's just not worth taking a chance. Don't try and game the system.
Yeah, somebody actually did the calculation on whether it's worth taking the penalty, but and I saw it and it was interesting. It was an interesting theory, but why play poker with the devil?
No, I agree. And also, I think you're quite right, André. I mean, from my side, with the actual dealing with the investment industry, they've got a lot of the stuff hard coded into their systems where it's just not physically possible for you to over contribute. As you say, you could try and open up 10 accounts at 10 institutions, but you are going to get caught, and you are going to pay penalties. And I can't make that. I mean, sitting here talking to you, I know I'm not a math genius, but I can't make a calculation work where you lose 40% on a contribution up front. And you look at the time value of money and future growth and all that. It doesn't, it's a bit like cashing in your provident fund and then saying you'll invest the money, after tax. It doesn't work for me. There's a lot of luck required to make that whole story work, and I don't like luck. I think we should plan for success and failure.
Yeah, that's true. Yeah, I think it's a fool's bargain to try and over contribute.
So let's just get the next question. Okay, so the idea that if someone hasn't before the end of the tax year, and I think that an important point here, that tax year is different to a calendar year. So a calendar year ends in the end of December. Tax year, because governments like to be difficult, they don't just end it at the calendar year. They decide they're going to end it at the end of February. In our case, in South Africa. So with contributions, what to a tax-free, what we're saying is you're allowed to make that 36,000 Rand contribution to the end of Feb. If you're sitting before the end of Feb and you haven't done that contribution, the question would be then, do you just do the whole amount before the end of Feb and then in March start a debit order of 3,000 Rand a month? And I think, I'll give you my perspective, and I'd love to hear what you think, Andre, but my view is tax-free is one of the very few gifts we get from SARS. It's a brilliant investment if you choose the right underlying investment. Putting in a fixed deposit or a bank account, I just think is an absolute waste of time. But putting it into high growth investment is absolutely critical. So if you haven't maximized your tax-free in the current tax year, absolutely, if you've got the money and you're not going to go into debt to make this this deposit, then please do it. I think it makes all the sense in the world. The next step, whether you then do the contributions on a monthly basis or annual basis, I like being disciplined, and I like to know that things are just going to happen in an automated way. So that's my personal preference. So I would run a debit order and I'd make it to 3,000. So I'm never going to over contribute. I know it's going to work, and I know I'm not going to forget something. But there are other people, and I think you mentioned it, earlier in the show, that there are people that will, almost on the 1st of March, if they can, they'll do the 36,000 straight up front and then go. And I can see the benefit of that because it gives the money the greatest amount of time to compound on a yearly basis. So I can see that there is a merit in that. And I guess for people who who have that memory, because my memory is not great, so I wouldn't trust myself to remember it every year on the 1st of March. If you do, there's absolutely nothing wrong with that strategy either. But I think there will be a lot around your circumstances and personal preferences. I'm not sure if you have a different view, Andre.
No, that's exactly what I was going to say. I don't think a lot of people have a luxury of having 36,000 Rand sitting around in some bank account waiting for the tax-free account to open. But the people that do plan for that, they can do that. I'm with you. I'm the type of person who likes external structures because my brain is going too fast sometimes for myself. So the more external structures there are, the better. So the monthly debit order works wonders. I will also forget about the March deposit. So doing the 3 grand a month is a great idea. But again, with a lump sum, if you have a cash available, always try to do the maximum before the year closes, because just because then you've actually put that money aside, and then you are not using that money for something else if it was intended for investments. So yeah. And I think my last comment just on tax-free, just as a general, is just remember that 500,000 Rand lifetime limit is a use it and lose it number. In other words, if you've built up 300,000 Rand in your tax-frees already, and you decide to use 100,000 to go on holiday, remember that you can't then in the next few years top up that 100,000 you've drawn out. It's gone. It's taken away from you. You're never going to be able to get that benefit again. So I think tax-frees are brilliant, and the only but in the whole conversation is it's a long-term investment. It's just not a short-term savings place. If you're saving for a holiday, a deposit on a house, or a deposit on a car, or buying a car, do it outside of your tax-free, not inside. Yes, I know the benefits are there from a tax point of view, but those tax benefits are actually compounded capital gains and interest and dividends tax savings over a 15 or 20 or 30 year period. It's not going to help you a heck of a lot over 3 or 4 years. Yeah, no, that's 100% correct.
So then I think we want to be value add on the show. It is called Honest Money, and so for listeners, what are the other things that they should be thinking about before the end of the tax year? What's the genius insider tips from the Tax Maverick?
Well, I think for most employed individuals, and even individuals who aren't employed but they're other self-employed commission earners or those guys, I think individuals always can take advantage of the retirement annuity if they can make a lump sum. It's just important to note that if you're on the higher percent tax brackets, say 39, 41 or 45%, the higher your tax bracket is, the bigger retirement annuity saving you can get. The big caveat with retirement annuities is to ensure that the retirement annuity that you do have is not expensive from a fee point of view. There was Spaces last night, and there was a lot of people on there, and one of the crux on the Spaces was the fees on RAs. And yeah, the big thing is it's a massive tax saving. So if you're at the 45% tax bracket, every 100 Rand that you put in, you get 45. You can get basically a 45 Rand tax benefit. But other than an RA, which I think is the average one, I think one thing that I feel people don't do very well is preparing themselves for the submission coming in July. So I know a lot of people scramble to get their documents together when the season already started or it's close to filing season. And so I think like making sure that if you have a travel allowance, make sure that you've got your logbook. If you have an RP5, if you've got an RA, medical, make sure you get those documents sorted. That's obviously after the financial year. But especially if you run things like rental properties, or you have a side hustle, which is becoming ever more popular, having the bookkeeping in place or something like Xero or some other type of system where you're at the end of a financial year, you are supposed to do provisional tax in any way, then you are prepared for that. And you have the stuff ready for your accountant when the time strikes for them to actually do the taxes. I also think for companies who haven't decided on finalizing bonuses yet, usually I know that February or December are often a good time to prepare for additional expenses, necessary expenses to lower the net profit a bit, in order to mitigate the tax liability by paying out extra bonuses. Usually it's done in the month of Feb with that type of planning. So those are the type of things that I would look out for.
Fantastic. I mean, I couldn't agree more on. So I just want to bounce back a little bit to the RA quickly. So I think, to me, costs are a destroyer of performance, and so I'm not saying that you can find any investment product that's free, because they must have a cost. And I think I'm always happy to pay a reasonable fee for good administration, good investment management, good implementation, and then great reporting. Because as we know, if you're not getting the right stuff reported to SARS from your product provider and to you, then you end up with real hassle. So I think be careful of trying to just get the absolutely lowest fee at all costs, especially bad reporting and bad administration. But my view, I'm not putting words into Andre's mouth here, is that I think RAs are absolutely brilliant if you choose them from an investment company. So in other words, a company that says we'll take your 1,000 Rand or 10,000 Rand a month contribution, all of that will be invested in the RA in your name. So there's no upfront fees, no upfront commissions or any of that rubbish, because I have a violent objection to people charging upfront fees on investments. And then they charge you a reasonable annual fee. And a reasonable annual fee, as far as I'm concerned, is somewhere around, if it's just for the product itself, somewhere around 1%, maybe 1.5% a year. A lot of the insurance companies, when I look at their costs, they're running at about 3.5 to 4.5% a year. And let me just tell you that, when you've got a cost of 4.5% a year, inflation of 4.5% a year, that means your investment needs to grow at 9% a year just to stand still. And unfortunately, stock markets, for example, in South Africa, have a long-term history of about giving you growth of about 12.5% a year. So that means you have to take enormous risk, which is not possible, in fact, to be 100% invested in shares, just for your investment to give you a little bit of inflation-beating growth. So you have to focus on costs. You can't ignore it. But that cost argument is not the reason to avoid RAs. It's the reason to find the right RA. And then I think the other criticism of RAs, which I think is somewhat valid, is the access to the money. So for people that are worried about living in South Africa and they're worried about accessing their money if they were going to immigrate one day, there is merit in that question. It's to me then to say don't be all or nothing. In other words, if you were going to do, is it 350,000 the annual limit that you can do if you're at the top end?
350, yeah, 350 is your limit that you can do.
So if you were one of the big earners and you could actually get a real tax benefit by contributing 350,000 a year to your retirement funds, maybe you contribute a bit less, still getting the tax benefit, and then you add additional savings to protect you for needing offshore money, for example. But I think this argument that you should avoid RAs in the event that you might immigrate in 20 years' time, I just think is not a smart one. And then the other thing that people often complain about is Regulation 28, which says it puts in limits in terms of how much RAs can invest in cash, bonds, property, shares, how much can be in South Africa, and how much can be globally invested. The interesting thing is, when you talk to the fund managers and you look at the returns that you would have got from being 100% invested in global shares over a 30-year period, if you were a South African, in an RA, if it was possible, or you were 100% or having the maximum share allocation inside an RA, which is, I think, at 75%, with the maximum offshore allocation, the differences in returns are almost nothing. So it's intuitively we think that we need to be 100% in shares, but we're forgetting about diversification. So actually, diversification helps.
Yeah, I was actually going to mention that that argument can easily be squashed, that if you decide to invest over and above your RA, you can decide how much you want to invest additionally offshore and how can I say, diversify your location risk without necessarily just looking at the RA. One important thing I do want to mention, if you do want to make a lump sum into an RA before the end of the year, very important, do try and make the deposit, or at least finalize the documents, at least in the second or third week of February. Last year I had an absolute nightmare of a problem. The particular client I was working with made a 350,000 deposit. The administrators at the fund didn't process the payment on time. So that payment reflected the 1st of March, and they lost the full, they basically contributed for the following tax year, and they couldn't make use of the RA deduction.
Yeah.
Because of poor administration. So yeah, if you are making a lump sum deposit in your RA, do it in like the second or third week of February.
And I'm sitting here and I'm thinking to myself, that's a very good point. But then I'm also saying, why are you waiting? If you've got the money,
yes,
get it in, get it done, get it out of your life. An important thing about RAs as well is that when the money sits inside the RA and it's fully invested, it's not paying any income tax, dividends tax, capital gains tax on anything inside the fund. And so tax-free growth inside an investment is a huge benefit, again, if you leave it for a long period of time. So delaying your contributions, because you want to kind of, earn the maximum interest or whatever it is in your own name before you then put it into your own RA, you're not actually being that clever about it, in all honesty. I know some people will leave it in their bond and then they overpay into their home loan and then take it out of their home loan and put it into their RA. That's a different story. I can understand that you want to be a little bit more kind of fine and clever with your deposits then. But if you're sitting on cash, cash is getting you 4%. Stop wasting your time. Put it in your RA, get it going, and let the investment start to grow in your favor. And Andre's point is great. Don't rely on product providers to deliver fantastic admin lastminute.com when every South African has left everything to the last second and they're overloaded. They just don't have the capacity to deal with thousands and thousands of additional transactions in a short space of time. So, Andre, if there are no other good sort of end of tax year tips, I'd love to talk a little bit more about the Tax Maverick. I know when we had a conversation some time ago, and I think it was before the first time you came on our show, it was a kind of a hush top secret, something you're working on, and you know, I love the entrepreneur journey, and so you're now a fully fledged entrepreneur. I'm sure you've got the scars to prove it already, and I'd love to just talk about your journey so far.
So yeah, it's been an interesting journey because I quit my job. It was in July last year, mid-pandemic, and we were still you know, my wife at the time also wasn't on, you know, she was at that time still employed, so we had double income, so that was good. And then August I took off, and then September we got started, and the first month was okay, but I didn't reach the target that I wanted, so tough month, couldn't take a salary. October was worse, and then my wife joined the company from the 1st of November as a kind of like an executive assistant and tax administrator, fulfilling those two roles. And in the month of November, we smashed the targets through the roof. So for 2 months, we couldn't take salary, but then in the month of November, there was first salary as an entrepreneur to get a decent salary and to actually make a decent living. And it's been going really well ever since. Yeah, and it's interesting. I've had the idea starting Tax Maverick with a 4-day work week. I followed a few companies. I followed the Microsoft idea, and I think it was, I'm not sure if it was Iceland or some other Nordic country decided to implement it actually in the whole country. You know, we are going to do 4-day work week. And I'm reserving all my in-person meetings for Friday, and it's working actually really well. And I think it would be interesting to see that implemented in a few other companies in SA. But yeah, it's been an interesting but tough journey.
So you are the guy that we talk to if we're individuals, or is it individuals only, or businesses as well?
It's individuals and businesses. So Tax Maverick has broadened to provide bookkeeping and accounting services as well. But Tax Maverick is primarily a tax advisory firm. It's my speciality. And I look at, profitability and also, tax management, effective tax planning. If you're on a group structure, or you've got a family business and there's a trust involved there as well, that is really my focus there.
So you mentioned early in the podcast accounting system, and I thought it was quite a nice hint that maybe we should just focus on a little bit for entrepreneurs who are on the entrepreneurial journey, as you and I. Well, you probably were better at it than me, but I mean, any entrepreneur I talk to that's not a tax person, one of their bugbears in life is the accounting and the record keeping and the tax controls. So what should people be looking at? I mean, I think you mentioned a system, and I didn't write it down. That people could look at. What are the good tools that they can use to automate their lives somewhat?
Yeah, I find that, and this is not a sponsor, but I find that Xero accounting software is absolutely godsend. If you're an entrepreneur and you just want to run your own books, it's very simple to actually do some of the processing. You can actually allocate the expenses yourself, send it to the accountant, or prepare it so that you can send it to the accountant. But I think that's a very useful tool. For some time I used Wave apps, which was fairly good, but I think Xero is by far one of the most useful tools. You can also do your invoices through there, so it's quite intuitive. Yeah, but I tend to say, if you're not an accountant or a bookkeeper, do the bare bones and leave that type of things and leave actually that for a good accountant. The one thing that I find happens often is a person will do their business and then not register with CIPC, then not get an accountant, and then they have to do 4 years of financial statements because they never had an accountant, because you need an accountant if you've got a CIPC company. The other thing is if you don't have an accountant, but you're an individual, so legally you don't need financial statements. The downside of not actually doing your books, if you've got a sole proprietorship or you've got a side hustle, is that number one, your financial management is a bit not being managed. Because you don't know how much profit you're taking, you don't know how much percentage of your income you should set aside for provisional tax, because you're not paying pay as you earn on that income. So having a program like Xero, or having a bookkeeper that you pay a monthly fee to, they can help you manage your. I think budgeting as well helps a lot, because then you know, okay, this is average what I make per month, rather than, oh, it's 100 grand this month and then 10 grand next month. If you smooth it out, you can plan for those things much better if you're a freelancer.
Brilliant. I think I couldn't endorse that more. And as André says, no one's paying us or sponsoring us. So anything we're saying here is what we think. It's honest money. It's our honest view, and I really appreciate that. Thank you, André. I think we're way over time, so it's been a fantastic show. I really appreciate your time and your insights. I'm sure our listeners will get great value, and we look forward to touching base again to find out how you and the Tax Maverick is going. Thank you so much. No, it was a pleasure. Time always flies when we chat, Warren.